Why do some people retire with financial freedom and others struggle and scrape to get by despite making similar incomes before retirement? This is a question that I've been studying for, I guess, over 15 years by this point, and I have figured out what I feel is the formula to achieving financial freedom. I call it building your financial fountain of freedom. So I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. Hello, everyone. My name is Brad N. Reed. I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Today, we're going to talk about indicators and how to use them and what they are. And in June, there's going to be a little bit of a schedule change, and I'll talk more about that later. But on June 3rd, which is 2 weeks from tonight, I'm going to start with options. And with some basic beginner study of options, we will talk about how you can use options to buy insurance on your positions, how to get paid when you are waiting for a stock to get down to your buy price. So if there's a stock I want to buy and it's above the price I want it at, I put in one of these trades every month and I get paid. Whether or not it fills, I get paid monthly. Similarly, if you're in a stock position and you have at least 100 shares, you can get paid every month as long as it doesn't hit your target. And of course, when it does hit your target, you just got paid to sell at your target. So how to generate monthly income, whether you are waiting to get in or whether you are waiting to get out. Then you can combine some of these option strategies to do something called a collar. You can lock in wins. June 10th, 1 week later, not 2 weeks, 1 week after June 3rd, I'm going to talk about Greeks. This is going to scramble some minds, but there is a webinar that's going to happen on June 12th. So it'll be an introduction, but June 10th, I'm going to talk about the Greeks, how to use them, and then specifically how to sell insurance to others that may be buying insurance, and how to win. If the market goes up or down, you don't care. But if you anticipate the market is in a squeeze and it's going to break one way or the other, how you can place one trade that wins regardless of which direction it goes. Then June 17th, we'll come back and we'll finish up with some fundamentals and portfolio construction. And then after that, I believe 2 weeks from that will be right at around July 1st. So have to decide if we're taking off. I'll be on schedule. I'll start multifamily investing on July 1st, if I get those dates right. Whatever the first Wednesday is in July. All right. I am building a 4-tier series. Over here on the left, it's how to be good. And by good, I mean get out of debt. Debt grows, it compounds just like your investments do. Consider debts negative investments. If you don't get rid of them, they will grow against you. Mindset is so important. You've heard me talk about you are the average of your 5 closest people. The one I want to share with you today is that a person's strongest need is to be consistent with their identity. So how do you define yourself? And what are the under the surface definitions that you have about yourself, the limitations that you put on yourself that you don't even know? Maybe you're a certain shape and you think you should be a different shape, but you'll always be that way. Or you're just not good with money, or you're not meant for business, or you're not smart, or you're not this, or you're not that. Whatever that identity is that you have beneath the surface can be limiting to you achieving your goals however you set them. Because once again, the strongest drive in a human is to be consistent with their identity. So in the mindset course, we'll talk about how to really dive deep into what is your identity and what do you need to change about your identity. We're in the section I call Dominate, where you're learning how to invest, how to build multiple streams of income. Maybe you still have your W-2 job, you're building a business or businesses on the side, but this is the step where you achieve your financial dreams. And then stage 4 is how do you live your best life? How do you be happy? because money does not buy happiness, whether it's the Maslow's hierarchy of needs, or the Bible says you will always have trouble, or you read stories about the ultra rich people, they have trouble. Um, let's see, I'm of that age where the Kardashians and oh, Paris Hilton and Nicole Richie were all over TV because they were super rich. They still had plenty of trouble. So if you think making lots of money means that you are happy and never have trouble, you need to prepare yourself. And that's kind of what stage 4 is. How do you be happy? How do you give generously? How do you save it and be able to pass it down to future generations and not blow it once you make it? This webinar and this series is not financial advice. This is for education and entertainment only. Should you want personalized financial advice, please seek a competent and hopefully licensed individual in your area. Bijan and I founded a fund called Indomitable Horizons. We do have securities available for accredited investors right now. However, nothing that we say constitutes an offer to buy or sell security. Those offers are governed and defined by a document called a private placement memorandum and deal disclosures. None of that will be included here. So if you want investment advice, tax advice, accounting advice, or legal advice, that is not what's going to happen here. Find a competent, licensed individual in your area. Your money mindset determines your financial future. Also, your fitness future, your relationship future. Your mindset is what drives your future. So if you want something different, change your mindset first. As far as your money goes, you need to calculate your desired rates of return so that you can calculate with inflation what rate of return you need. And then we can talk about what investing styles and types will get you that rate of return. Maybe you need to be heavy into private equity. Maybe multifamily will serve your purpose. Maybe you can get it all just by hiring a financial advisor and you can just retire and let someone else take it over for you. I don't know if I trust a random stranger to do it for me, no matter how much money I have. But the first step or the second step is to calculate your desired rate of return. What's up, Sam? Then you want to structure a great portfolio that will achieve your desired rate of return, that is diversified, non-correlated with other markets, and each investment has asymmetric risk reward. The priority is usually real estate, then private equity, then public equities, followed up by energy and alternatives. Be sure that this portfolio serves your needs for cash on cash and equity growth in whatever stage of life you may be in. We got investments now. Swing over to that website and click the contact page if you want to talk, if you are accredited and want to talk to us about investing. Reminder, how we learn is 10% by reading and listening. That means that just by listening to this webinar, you will only get about 10% of what you need to develop this skill. That means there's a lot left outside of the skill. 30% will be discussing with others. Maybe we form a mastermind, something like that. And then 60% is by actually doing it. We can practice together if we have that mastermind. Hint, hint. Okay, so this is the grand scheme of the financial fountain of freedom, what I'm going to cover. We are still in the stock market education piece. All right, so last time we talked about a webinar that's coming up on June 12, 13, and 14. Hopefully you've blocked your calendar. If you have not, do so now because it is a go. I have talked to the organization and we are forming a team that is going to attend a webinar together on June 12, 13, and 14. The cost will be $47 if you jump through the hoops I'm about to mention. So I'm going to hold a special session, as I said previously, on June 10th. So in June, I'm going to go June 3rd, June 10th, and June 17th. But that way we get through the bulk of the material before that weekend-long webinar, which they will not only repeat, reiterate, but also give more details. There will be coaches there that we can all talk with as a group, and we can practice together. It's like that other 30 and 60% I was just talking about. All right, so actions you need to take if you have not already. Go to this website, rule1investing.com, and wait for a little pop-up that'll say join the 20-day mini course. Join that 20-day mini course and then check your email. I didn't find it till the fourth one. They claim it's in the first one, but whatever. In the emails that you will get, look for an invitation to join the workshop and then follow that link. By the way, that mini course is free and it's one, maybe two emails a day for 20 days. And then they stop, or at least they say they will. But they will have links where you can join the workshop for $47. Bijan says it's also in the last day email 20. Bijan, I found it on the fourth one, and they say it's in the first one. So it's there. If you have trouble finding it, let me know. Verify the cost is $47 and then register for June 12 and June 12 to 14. And then email me the name and the email you use for registration. I will turn in a list to Phil Town and his Rule 1 investing group, and they will do their best to put us all in the same breakout room. I think they said they limit their breakout rooms to 10. So if we have more than 10, they will divide us up into 2 or 3, however many breakout rooms. I already sent it. You should have already gotten an email from me. I sent that to about 50 people, but hey, it's summer. People have busy schedules. Sam says she found it. Bijan says he found it, and I found it in mine. So that's at least 3 of us. So Sam and Bijan, please be sure that you email me the name and the email that you gave that organization so that I can inform them to put us all in the same group, please. And do that by emailing me, brad@indhrs.com. All right, I'm going to shorten up the review because I should not be taking 30 minutes just for the review. So I'm going to go faster today. An analyst is anyone who publishes research that can be good or bad, downright awful, completely biased, and research and price targets on companies. The person that puts air in your tires at the tire change place is more heavily regulated by the government than stock market analysts. Let that sink in as you read these articles. Brokerage is a company that executes orders on your behalf. I like Charles Schwab. That's one more thing before the webinar on June 12th. They will use Schwab. They will use the Thinkorswim platform. So I will put this, let's see, if you're watching this on YouTube, this link will be in the description. If you are here live, then you are registered and you will get a confirmation email that will have this link in it, or you can go to the YouTube videos. Every email I've been sending out for quite a while has it in it. So if you want to get on the same platform that June 12, 13, and 14 webinar uses, that I use, grab that referral code, sign up. The last time I checked, you could sign up with no money and use their platform for free. All right, an exchange is where stocks are bought and sold. And then the market maker is the firm that stands ready to buy or sell at any time. You need to understand the market maker. The market maker is complex. Some of y'all that were here earlier, remember AI could not figure it out. I had 3 or 4 iterations of AI and it just couldn't. So I created this myself. If you are buying stocks, you will pay the price called the ask. The ask is always higher than the bid. The bid is what a seller gets when a seller sells. The difference between the bid and the ask is called the bid-ask spread, not to be confused with a very large buffet. But a bid-ask spread is the profit that the market maker gets. So if you are buying, look for the price at the ask. If you are selling, look for the price at the bid. And just one reason why some people like options is you can manipulate the bid-ask spread in your favor. Candles are really, really important, folks. If you want to be a stock trader, you need to understand candles because candles not only tell you where it closed, but it also tells you where the stock opened, the difference between yesterday's close and today's open, what happened during the session. You get to see the high and the low, understand candles. And if you just look at them for a couple of days, couple of weeks, your eyeballs will figure it out. But yeah, the first time it's pretty confusing, but by the 30th time, the 100th time, you will get the swing of things. The wick is an indicator of what happened during the session. So if you see a long upper wick, there was probably a reversal in the middle of the day. It means the sellers took over. If there's a long lower wick, it probably means that the buyers took over and finished strong with buyers. If there's very small wicks or even no wicks, that means either the bulls or the bears dominated for the entire session. And if you see a doji is just something with a really small body, long wicks on each side. That means there is a battleground. Neither side won, and it could continue in whichever other direction that it breaks. If you see one of these dojis at support or resistance, it could be a reversal signal. If you see it in between support and resistance, it could be a continuation signal. All right, so an update on Schlumberger. I did get stopped out, but I got stopped out for a small loss. And remember, the rule is to win big or lose small. I lost small. So I followed my trading plan. It was a good trade. Remember, a good trade is whether you follow and obey your trading plan. It doesn't mean whether you win or lose. So what happened? I saw a ascending wedge. Those tend to break bearish. It did break bearish, really nice and strong. I got this little doji here. And remember what I just said, when it's whichever way it breaks, it could be a reversal or a continuation. Well, as you see, I got this really big, strong, bullish counterattack candle right here. These three make something like a Morningstar reversal. And I knew on this big bullish candle, it's hard to see the wicks in the resolution, but there's almost no wicks on this candle. It means the bulls took over and took over really, really strong. I was hoping these three candles were a retest of this double top here at a pivot, but it turned out to be a bullish flag formation, and it continued bullish, and I got stopped out for a small loss. Very happy on this trade. I did what I said I was going to do. I followed my plan. I can always tweak and change my trading plan. But if I trade emotionally, if I'm slamming stops, if I'm exiting early, if I'm trading emotional and willy-nilly, and I want to make improvements, that is very hard to change. So overall, a win for me, even though it was a small loss of about 120 bucks. All right, last time we talked about a trading plan. The reason, and I just talked about my trading plan, right? Why I'm happy with that trade, because I followed my trading plan. What is a trading plan? It's a set of rules that you follow. Because before you are in a trade and after you are in a trade, you can be very logical. But while you are in a trade, you are either hopeful or you are fearful. And there's nowhere in between. It's one or the other. We can do all the stuff we want to with our mindset, but it's very hard to listen to logic and intuition when you are in a trade, which is why we have a trading plan. If you have ever looked at books about investing, if you're old like me, and you've been to a bookstore, like a physical bookstore, I remember being in a Barnes and Noble in, where was it? Overland Park, Kansas, which is on the Kansas side of Kansas City. Yes, Kansas City is on both sides, Kansas and Missouri. But I was in a bookstore and I remember, wow, half of these books are about mindset. So get a trading plan, execute your trading plan. When you have created a rough draft of a trading plan, look at the charts, find your entry, your protective stop, your target, manage it according to your rules, do at least 100 of those, and then see if you want to make any trades. If it passes the test of 100 charts, do a back test. Okay, this is where you use the software where you don't see the next candle, whether you're trading days, hours, minutes, whatever. You can't see the candles in the future. So you have to apply your rules by revealing one candle at a time. Then you paper trade. This is where you trade in real time with fake money. This takes a long time, especially if you're trading on the monthly chart. So, but be patient because one strategy that works and you know how to do it will change your freaking life. So be patient and get one that works. And then stage 4 is to trade live with a small r, because paper trading with fake money and trading with a small amount of money are two completely different beasts. Do those 4 phases. I like using the R system. It's where you identify your risk unit and you trade in R. So maybe I'm trading a $50 R, you're trading a $200 R. I can say, hey, I took a 0.6 R loss. And you can say, great job, Brad. And you can tell me that you got a 2.3 R win. I can be like, great job, dude or dudette. But the point is, it's the R is based on your risk unit, and everyone's going to have a different risk unit, what they feel comfortable with, based on their comfort level, their risk tolerance, and their account size. I have a trade journal that you can use, you can download. I'm not sure, I have to say I'm not sure all of the formulas are correct because I did do some adjusting to it right before I made it public, but you can go grab that, click File, make a copy to have your own, because the one at the end of this link is a public one and everyone can put stuff on it and trade it. Hopefully I protected the formulas. If you see it's corrupted, let me know and I will go reset it. All right, today we're talking about indicators. One thing you need to know, you absolutely need to know, indicators do not predict the future. If someone says, hey, I have these indicators that help me predict what a stock is going to do, stop listening to that individual. Indicators help you analyze what has just happened. I will repeat, indicators do not tell you what's going to happen in the future. They are lagging indicators. They lag behind the data. So what is the data? Every stock chart only has 3 pieces of data on it. 3. Price, time, and volume. Price, time, and volume. Some stock charts don't have volume on them. You need to put volume on your stock charts. If you were looking at stock charts without volume, you are missing a third of the information that's available to you. Now, the last point I'm going to make on this, there's a gazillion indicators out there, hundreds, maybe thousands. They all do special things with math and pictures with price, time, and volume. So if you can look at stock charts and learn how to analyze price, time, and volume with your eyeballs and your brain, you do not need indicators. Most of the really big professional indicators that I have worked with, they use 0 indicators. 0, not even moving averages. These are the ones we're going to talk about today. Let's get going. Volume is one of the most crucial pieces that you need on your stock charts. Make sure it's there. Volume, that's these things down here at the bottom. I do not like how Thinkorswim color codes these green or red. I like red ones to be bearish days and green ones to be bullish days. The Thinkorswim insists on making red bars if the close of the current session is lower than the close of the previous session. I would rather the color be compared to the open or close of the same session. But what do we get by volume? Number 1, the strength of the indicator. See this double top right up here at a pivot? And see this volume spike right here? That means that's a significant indicator. It turns out it is. If you see a stock making a big run and you get big volume at the end of the run, that's called exhaustion volume. Notice how the stock is running bearish and the red candles are bigger and more frequent than the green candles. Okay, that's the sign of a bearish run. Notice over here how the bullish candles seem to be more prevalent than the red ones when it goes into a bullish run. Notice on the breakout, right? Actually, it's on the retest. See that volume spike right there on that retest? That's an indicator by volume that, thank you, Bijan. That's a indicator that this could be a significant breakout and run. And then you've got exhaustion volume up here, some sideways action, another big breakout there, big exhaustion volume, but that's right after earnings. So earnings kind of monkeys with it. Always have volume on your chart. Always have volume on your chart. Okay, moving averages. Every stock trader likes to have their own moving averages. If there's two major flavors, there are SMAs. SMA is a simple moving average. It is a mathematical average of the last number of periods. So a 100 SMA is the average of the last 100 trading sessions, typically the close. The 200 SMA is going to be the average of the last 200 closes. Yes, for those of you that are technical, it includes the current price of the current candle. That's being technical. Just don't send me emails that I got it wrong. A EMA is an exponential moving average, okay? That means the more recent candles have a heavier weight in the weighted average. So the candles that I like, the numbers that most traders use are 10, 20, and 50, 100, and 200. Those are by far the 5 most common numbers for moving averages. 10, 20, 50, 100, 200. Almost everyone that uses the 100 and the 200, they are simple moving averages. When I'm trading, I tend to be a faster trader, a shorter term trader. So I like exponential moving averages. I think I took a peek at Sam's charts one time, and she uses simple moving averages. And then you'll see some charts, get the 8 EMA or the 9 SMA, because you'll get your signal before the 10 moving average traders, and you'll get to get in and get out before they do. Everyone's got their favorite numbers. Start with the 10, 20, 50, 100, and 200. Or just start with the 10. Whatever works for you. All right, I will show you my moving average here in a little bit. Wanted to talk about something called the volume weighted average price. This is very technical formulas and definitions on the page here. Hit pause, read those if you want to. It is a moving average, almost always used by intraday charts, not daily, weekly, and monthly traders. But the volume weighted average price is it's a moving average based on price and weighted by the volume that was traded in that time frame. So if there's a time frame where there's a lot of volume, then the price action gets a heavier weight when calculating that moving average. Sam verified she uses EMAs. All right, rock on. Now, I don't care that you know exactly how this line is calculated. What I would like you to know is that the rumor is that institutional traders, by institutional traders, I mean the really big money traders, like those that are trading 7, 8, 9 figures, maybe more of a particular stock. The rumor is they get measured based on how close to the volume weighted average price they execute their trades. So what that means is it tends to become a magnet. And when the price action gets far away from the volume weighted average price, volume tends to drop off and it is allowed to return to the volume weighted average price. It also means it tends to act as support and resistance intraday. So if I'm day trading And I see this up and down action. I see a lower low than a higher high and think this stock is just drunk. But I see this big break and it pulls away from the volume weighted average price. I am not going to short this stock down here. I'm going to wait for it to pull back into that volume weighted average price before I'm going to short it, which might have happened right around in here. I don't see a signal I would have taken, but you see that it pulls into the volume weighted average price and gets rejected. It drops down here and it gets sucked back to the volume weighted average price and wiggles. And then it breaks bullish. And it goes on an incredible tear, makes I'd probably call that a triple top. And then it comes back to the volume weighted average price and it bounces at the volume weighted average price. It wiggles here before continuing on bearish. So if you use the volume weighted average price, just realize it will act as a magnet for the stock when it's far away, and it will also act as support and resistance. And I should say all of these signals are barring any kind of crazy news. I was in was it Boeing? I think I was trading Boeing. I was doing a day trade and I was bearish, and really bad news came out about Boeing, and it just tanked. And it slammed into my target before I could readjust, before I could lower my target and trail my stop. But in a case like that, where you get bad news about Boeing, volume weighted average price becomes meaningless. And that thing, well, let's see, most of the metaphors that I would use about a stock going down are inappropriate to use about Boeing. But uh, if we're trading together, you will hear me use really inappropriate metaphors when a stock's going hard one way or another. Oh, Bijan and Sam, Derek, aren't y'all glad I kept it clean? I mean, my mom and dad are watching. I didn't get inappropriate. But when we start trading together, um, I'm just going to get myself in trouble, and I'm going to go see my mom and dad soon. Yay. Okay, next one. MACD, moving average convergence divergence. A lot of really expensive words, really confusing numbers. Basically, it's just a way to see if the stock is moving fast or not. If it's moving fast, the moving averages will be spreading apart and you'll get big bars. If it is not moving fast, you'll have very small bars. The moving averages are coming together. I think the best way is to go turn one on. All right, so on this picture, I have let's see, I see the 10 exponential. Oh, I don't have enough room up here for you to see it. But up here is the 10 exponential, that's the brown line. The 20 exponential moving average is the navy line. The 100 simple moving average is right there. And the 200 is down below. Someone give me a stock ticker in the chat pane. Something that's got decent volume that people have heard of, not one of your fringe wacko ones. Bijan, what's your favorite ticker? Sam, Derek, mom, dad, type it in. All right, Tesla was first. TSLA. I'll do CDNS next. So here is Tesla. And let me change this to, let's see, I got a daily chart. Let's put 5 years up here. Yeah, there we go. Scoot that over like that. So I've got my volume down here, 100, 200, 10 is the brown line, 20 is the navy line. I am going to attempt to turn on MACD. Go down here to studies, add a study, and gosh, I got all this stuff in the way. Sorry, Zoom has interface things so that I don't get in trouble, and my toolbar is still in the way. All right, studies, add study. I really like TradingView better, but I don't want to pay for that. Let's see, M. So I'm going to go to all studies and come over here to M, and MACD should be in my face. It's not. Is it under moving? Okay. I'm going to come over here to one called the 3 arrows rule that I know has moving average convergence. That's this thing down in here. Notice when I'm getting big spikes, the stock is trending fast. When I got big spikes, it means the fast moving average and the slow moving average are far apart. So there's the 10, there's the 100. Where'd my 20 go? Oh, I don't have the 20 on this one. All right. Well, when it's trending fast, the moving averages are far apart, and that's why you get the big bars. When it slows down, it comes down to zero, and the moving averages can actually cross if it's going, it doesn't have to go bearish if the moving averages just cross. So if you have red MACD, that means that the faster moving average is below the slower moving average. If you have big green bars, it means it is trending. MACD is a speed indicator and in which direction. And if these things are confusing, skip it. Because again, most professional traders do not use indicators. Wow. I guess you can see that a little bit better on your screen than on my screen. Stochastics is another one that a lot of people like. Basically signals if the stock is overbought or oversold. There's two zones. There's an overbought zone up here at the top above 80%. There is an oversold zone down here at the bottom below 20%. If a stock gets into the oversold zone down here, you might look for a bullish signal when it breaks out, when it breaks up out of the oversold zone. And similarly, a sell signal may be when it breaks out of the oversold zone. This bottom one down here is a slow moving stochastic. And as you can see, as the stock made an upturn here, so did the stochastic. As it turned downwards, it went back down. As it made a big break here, it came out of this oversold zone and broke bullish, and it stayed overbought for quite a while. Notice a stock can stay in this overbought zone as it trends upward. So it doesn't mean you have to sell. It just means, hey, heads up. It's going bullish, and now may not be the best time to buy. But you have to read your indicators and choose how you want to interpret them. When I'm trading, I look at moving averages and volume. And if I'm day trading, I add the volume weighted average price. I do not use these. But other people do, and you will see them on the June 12th webinar. So I wanted to give you an introduction. All right, the relative strength index is very similar to stochastics, but the math is different. So RSI looks at the last several candles. You decide however many. AI is telling me that the default is 14, and it decides have there been more buying days or closing days, and by how much. So how strong is the stock? And there is a 30% level and a 70% level. And if it's over the 70%, the relative strength is incredibly bullish, and it may be at the end of its run. If it is down below 30, there has been an extraordinary amount of selling going on, and it may be oversold. The last one to talk about is called Bollinger Bands. These are fun. You get two bands and then a middle line. The middle line is the 20 simple moving average, and each band is two standard deviations above and below that 20 simple moving average. So we're looking for a couple of, one signal in particular I love almost as much as the wedge. It's called a squeeze. When the Bollinger Bands get really, really tight, we call it a squeeze. And that means that for some reason, the volatility has just dropped out of it, and it's waiting, it's coiling, and likely a big move is coming. Now, if you see a squeeze, the first thing to do is to check if the company got bought out. Because if a stock is getting bought at, say, The buy price for the company is $41.15 per share. The stock will generally move to $41.15 per share and then fall asleep. Yes, it will be a squeeze, but not because people are resting, but because they know the value. It's been revealed. All righty. Before I jump into the three or go back to the three arrows rule, let's take a look at Sam's stock. Yes. C, D, and S. All right. Sam, any basic questions on this one? I don't see a good squeeze on it. And my interface is not working well with the Zoom controls. Ooh. We may be able to see a little bit of a squeeze down in here. Once again, folks, all of these indicators are combinations of price, volume, and time. So if you learn how to read, gosh, come on, help me out. If you learn how to read price, volume, and time, these indicators become distractions. So I'm looking at my other monitor, which is bigger. I don't really see a good squeeze. Anybody know of a stock that's in a squeeze right now? That's kind of close. See how this upper line and bottom line are getting really tight, but a good squeeze is going to last longer than that. I remember a while back, my dad found a squeeze on Netflix, and a lot of people made a lot of money. So a squeeze is going to look like that, only much more narrow and for a little bit longer. Cool. Sam says, I wanted to see you apply some indicators. Anything in particular, Sam? Go ahead and ask. And while we're here, I do see a pattern that we can talk about with Bollinger Bands. Stocks tend to what we call walk the band. And so walking the band is a great indicator right here. See how the stock is following this upper band and then it pulls back to the center line? And when it gets outside the band, it tends to get back to the band very quickly. So if you're trading CDNS bullish here and you see it walking this band, it's a very bullish indicator. Walking the band, walking the band, walking the band, walking the band. All of these times where it breaks off of the 20 simple moving average, great place to raise your stop. Now here you see it broke below the band. That's unusual, but we had earnings. And really, folks, come next time if you want to see how to play defense. If you have a stock, I don't care how many shares you have. I hate to use the word always, but over earnings, geez, buy some puts. Buy puts. And we'll talk about that next time. But Sam would not have held this over earnings. And if she had, she would have had some puts. But let's say Sam saw this action right here, saw this horizontal lower band. This is a good bullish signal right there, that break across the 20. Let's say Sam entered there, bought her puts, stayed in it through there. And then who knows, maybe she stayed in it through there. It broke higher. But just notice how it tends to trend between the midline and the band, whether it's bullish or bearish. Came to that midline, wiggled, broke lower, and walked the band lower before it crossed to the upper band. Wide Bollinger Bands mean volatility, mean big moves. Narrow Bollinger Bands mean small moves. Okay, Sam said I wanted to see me apply some indicators to it. So let's do that. Anything in particular, Sam? It's not the right one. Where is it? So here is the stochastics. Notice on this time right here where we were saying MACD. Cool, I'll do that one next. While we were saying in the Bollinger Bands, it was between the 20 simple moving average and the bottom band, and it kind of fell asleep. And this breakout here would have been might have been a good signal. Same thing with down here. See how it's hovering around in the oversold zone? It would have been a signal. And man, notice how fast it jumped up to the oversold. Interesting here how it fell asleep. Likely that's when it pulled back to the 20 simple moving average on the Bollinger Band, and it dropped back into the oversold zone, indicating another potential buy signal. No more potential buy signals until after this earnings gap, and it pulled down into here, made that little, that's not a cup and handle. What is that? That's really small. That might be a Morningstar reversal. But the stochastics show that it pulled back into the overbought zone. Sorry, excuse me, oversold zone and ready for another breakout. If you got questions, type them in the chat pane. It's another reason to come live. MACD. Okay, not there. Where is it? Moving average? Come on. I know it's in there somewhere. There we go. So again, the MACD is just going to tell you when the moving averages cross. The default is a 12 exponential moving average, a 26 exponential moving average, and this third number here is it's a smoothing factor. So you aren't whipsawed. Yeah, thank you, Sam. That's a microphone brain, right? When I'm holding a pen explaining on a whiteboard or have a microphone in front of my face, my brain's just too many tabs open. Multitasking too many times. But yeah, so if you want more signals, you can reduce this third number. If you want less signals, you can increase that third number. But this big green section here is reflective of the speed it moved there. And all this says is that the 12 and the 26 exponential moving average are far apart. On this pullback right here, you see red histogram. That means that the 12 exponential moving average actually dipped under the 26 exponential moving average. Over here, you see a really fast pullback indicated by the size of the red histogram here. That means the 12 exponential moving average was really far under the 26 exponential moving average. Sam, before I pull up the three arrows rule, let me know if you got any specific questions. Or actually, I'm going to go talk about the three arrows. And if you have a specific question, red bars might be okay. Sam, I'm going to talk about cash secured puts, but when is good, when's bad, but a slightly different way. I like selling options on high volatility. And on the June 10th session, I'm going to show you my my option volatility chart, but Sam's getting into the Greeks. So part of the value of an option has to do with a Greek called vega, which vega is a measure of volatility. And when a stock is moving fast, volatility is high. When volatility is high, I like to sell options because options are priced high. When volatility is low, vega is low, therefore the premium on options is low. That's when I like to buy options. So if I want to sell cash secured puts, I look for a down day. Big, big down days, better for selling cash secured puts. Big up days are better for selling covered calls. And likewise, the opposite. Big up days are great for buying puts because they're cheap, because the stock's moving up. So callers on big green days, lots of fun because you get a lot of money for selling the call, and buying the put is super cheap. So that goes into another thing, folks. Be careful what you ask because I will answer it. Hope I didn't. Sam's following me, but I hope for the rest of y'all, we'll get there in a couple of sessions. And once again, folks, you're only going to get 10% from me talking here. You got to ask questions. This stuff is a skill. Okay, 3 arrows rule is a really, really neat combination of indicators. If you come to the June 12th webinar, my expectation is that they will go into the 3 arrows rule. They will actually give you a code that you can copy and paste into Thinkorswim, and you can create the 3 arrows rule. I've showed it to you before. I'm about to show it to you again, but a really cool little strategy. And yeah, one you will get for free at the June 12th webinar, which is why I have talked about it. I will not talk about strategies that I paid money for. I did verify that this is very public. And yeah, they grilled me about how much I've been talking about the 3 arrows rule. At any rate, the 3 arrows rule has 3 indicators: the 10 simple moving average, MACD, and stochastics. If you get 3 signals in the same direction, it's a buy signal. If you get 3 in a row, if you whether bullish or bearish, but if you get only 1 or 2 before you get an opposing signal, you do nothing. So 10 SMA, MACD, stochastics. I have this programmed on here, so I can say studies, load 3 arrows rule. Booyah! There it is. Let's take a look at just a small section. So what I am looking for is when I get an upturn in stochastics, which happened here. The arrows on the stochastics only trigger when it crosses the overbought or oversold lines. So you have to look more than just the arrows. But I see an upturn. I see a green arrow there. 1. I see it crossing MACD 0 line. That's 2. And I get a close above the 10 simple moving average 3. I get 3 bullish indicators, 3 bullish signals in a row. So I would have bought at the end of whatever this is. I would have bought at the end of the day or open of the next day on July 9th on CDNS. And I would have held until I got 3 red arrows in a row. And so I get a downturn of stochastics here. I get a cross of the MACD here. And yes, I get a close below the 10 simple moving average here. So I would have bought in here and sold up in there. And then notice I get a close above the 10 simple moving average. And before I get the upturn down there, I get a close back below. So I'm 1 red candle. Now you see this upturn right there that's no green arrow? That's a buy signal. The MACD crossing 0, that's a buy signal. A close above the 10 simple moving average, that's a buy signal. This one, so I would have bought somewhere up in here, but what I see over here is a downturn in stochastics, MACD crossing zero, and over here, I get a close below the 10 simple moving average. So this one would have been a small loss. This one would have been a big win. This one would have been a small loss. And guess what? You get the 3 arrows rule, you use your trading plan, and you do like I'm doing here. You look back in the charts, you map 100 of these to see if it would win or lose on the daily chart on your stock. And if you don't like that, then maybe you swing over to Amazon. Maybe it works on Amazon, but not CDNS. And then maybe not the daily chart. Maybe you try it on the hourly chart. Maybe you try the monthly chart. What kind of trader do you want to be? Do you want to be checking it every single day? Do you want to be checking it every 5 or 10 minutes? Do you want to be checking it once a month? But you do 100. Then you back trade where you can't see the next candle. You go click by click. You do 100 of those. Then you paper trade. You do 100 of those. That paper trading goes a bit faster when you're working with a team. And then you start trading it live with a small amount of money. Questions about indicators? Hey, look at that, almost an hour. Okay, I'm going to go back here. Next time, we're going to talk about the simple use of options, if there is such a thing as simple use of options. This will be June 3rd. June 10th, take a nap, drink an energy drink, because this is going to be intense. You may need to watch episode 11 several times before you get it. You may need to use AI and say, hey, teach me what the heck Brad was talking about with Greeks and implied volatility versus historical volatility. And how do I use this triangle? And how do I use theta and delta and gamma? Forget about rho. Rho changes too slowly. All right. So if you are interested in building your financial freedom, understand where we are at in the process. Number one, you've got to work on your mindset. Your mindset will determine your future on everything: relationships, finance, health, fitness, everything. Calculate your desired rate of return. You can get the calculator there for free. Structure a portfolio that will give you your desired rate of return after inflation, right? The big thing about needing to know your desired rate of return is with inflation. IARC stands for Inflation Adjusted Retirement Calculator. You can memorize it off this chart, or you can go grab it in the description. If you're watching this on YouTube, it's in the emails that I send out. And thank you, Bijan. Bijan just put it in the chat pane. Oh, by the way, it's free. Structure a portfolio that will meet or exceed your desired rate of return with investments that are diversified, non-correlated, with asymmetric risk reward. Preferably one, or let me say this part. If you're accredited, you get access to investments. Well, that's not true. You can be non-accredited and still have access. Just a little bit harder. Bijan and I are working on that. Promise you, we think about this weekly, if not more, how to get non-accredited investors access to apartment deals, private equity and businesses. Of course, everyone has access to stocks. That's why we call them toilet traders, because you can pull out your phone while you're on the toilet and buy and sell stocks. Not sure if that's a good thing. Energy. Wow, all of the energy investments I've seen, you need to be accredited, and alternatives come in a lot of different flavors. Be sure your portfolio serves your needs, whether you're in retirement or before retirement. We have investments now. Currently, they're just for accredited investors. If you're not accredited and interested, let us know. We'll see how we can help you. All right, how we learned 10% by reading and listening. So thank you for those that are here live and asking questions. Find yourself a group, discuss with others, preferably people that are at the same rate or further down the road than you are, or else you are not growing. And then by doing, practicing is how you learn. Think about how you learned to swim or ride a bike. You did not just listen to someone. You had to get out there and swallow some water and get some bruised knees and elbows. All right, folks, that's it for the day. Thanks for being here. Follow us on social media. We do post lots of stuff. Ask questions. You rock, Sam. You're welcome. Thanks for being here. Thanks, Bijan. Thanks, Mom, Dad. Thanks, Derek. Thank you, Ian and Cheryl's note taker. Thank you for everyone that watches the videos. Y'all have been sending me some very nice messages. I appreciate it. I know many of y'all just wait for me to send you the video. I appreciate your energy, your participation, and your support. Y'all have a good night. And as always, trade on logic, not on hope. God bless you.